As expected, the U.S. Federal Reserve held its key rate steady at 5.5%. Joining us now for his reaction is Scott Colborn of TD Asset Management. And Scott, the Fed seemed to make an important pivot today. They highlighted a more equal focus on both inflation and jobs. So my question to you is, has your baseline scenario on a possible rate cut in September changed?
No. I mean, we and the market primarily have expected the Fed to cut in September. And today's, statement and press conference basically has, given the Fed the optionality across all of its data to cut in September. So it highlighted that, the jobs market has moderated and inflation has, come down. It's cooled, but it's still somewhat elevated. So I think on the balance, the changes in the first two paragraphs of its statement give it scope to cut rates in September.
Okay, now there's signs that inflation is moderating. We're seeing improved consumer confidence. The labor market is getting closer to neutral. Is this consistent with a soft landing?
Yeah, the credit market, the equity market, fixed income, on balance, I would say that market participants and the Fed continue to see evidence that this is a softer landing. Everything is coming closer to neutral, if you will, and given the stance of monetary policy, which by many measures, including the Fed suggesting as much, that is tight, very tight, that we need to start moderating that tight monetary policy, given the trajectory on both growth and inflation.
Okay, now what is the bond market telling us about the path forward and timing of interest rates, potential interest rate cuts this year?
Today's decision really didn't move the needle too much in terms of what's priced in. Between now and the end of the year, there's roughly about 2.5 cuts priced in. So obviously a little bit of optionality and uncertainty in the markets. But basically September is fully priced in and December is priced in for 2 cuts, 50 basis points. We saw a little bit of bouncing around after the announcement in the capital markets. But by and large, the markets expect the Fed to cut. And so really 10-year rates are a little bit lower. The foreign exchange market saw a little bit of weakness in the U.S. dollar, and the equity markets were up on balance. And so no real substantive market reaction post announcement.
Okay, I'll get to the U.S. dollar in just a moment, we do have the U.S. elections coming up, and any implications to the shifting U.S. political landscape on Fed policy going forward?
Well, obviously, there's been a big change in terms of the political landscape with Biden out now, and the markets have focused on the Trump trade, which is tariffs, the desire for a weak U.S. dollar. I think we're not completely clear on what the Democrats will lay out going forward. So there's a heightened degree of uncertainty. There's going to be more information, between now and obviously the election. But on balance right now, the markets are really focusing on what they know, and I would say in the shorter term, there's a lot of other factors like the Fed that is driving the markets at the moment.
Okay, we'll get back to currency now. Given your outlook on rates, what's your outlook for the U.S. dollar going forward?
Well, on balance, I think this doesn't really move the needle too much. You've got a cautious Fed that is slowly going to be looking to reduce its tightness in terms of monetary policy. It's not a real pushback against the U.S. dollar, but I would think that on balance, over the course of the next year, given the direction in terms of monetary policy, that you'll start to see a slight weakening in the U.S. dollar. But this doesn't really move the needle substantially for a massive weakening in the U.S. dollar. Okay,
so now looking ahead, what will you be watching closely in the next few months that could potentially change your view on rates?
Fed is telling us data dependent. There's non-farm payrolls this week. That's one indicator. We'll have more jobs and inflation data between now and September. We also have Jackson Hole, and I think that's another signpost along the way that the Fed can nudge the markets, depending on what data come out. And if things are just basically on track, the Fed will be comfortable moving in September, but it'll give it a scope to adjust to Jackson Hole will give it scope to adjust given the data.
Scott, thanks again for joining us.
My pleasure. Thanks, Anthony.
Thank you.